Hey everyone, welcome back to Real Estate Watch. My name is Deloshan. Big news just dropped. The Bank of Canada is holding its interest rate at 2.75%. So let's break down what that means to you, your wallet, and the housing market. So despite recent signs of economic slowdown, the bank chose not to lower interest rates further. Why? Because things aren't falling apart. They're just softening a bit. The Bank of Canada Governor Tiff Macklem said there was a clear consensus to wait. And the big reason? Well, the uncertainty around the US trade policies, especially new tariffs, remains the biggest threat to Canada's economy. Here's what's interesting. Just last week, we got stronger than expected GDP numbers. For Q1, the economy actually grew faster than most experts even thought. But at the same time, inflation is creeping back up. Even with the April dip to 1.7%, thanks in part to the removal of the carbon tax, the bank is still laser focused on one thing: keeping prices stable. At the Bank of Canada, opinions are split. Some members believe if US tariffs continue and the economy further weakens, there may be room to cut rates. But for now, they're staying cautious. So, what does this all mean for you? Well, if you have a variable rate mortgage, your payments will stay the same, at least for now. If you are looking to buy a home or refinance, rates are still relatively low, but don't count on deeper cuts just yet. And for investors and business owners, this is a wait and see game. The bank is watching the US and the inflation closely before making its next move. So the bottom line, rates are holding at 2.75%, but the pressure is building. More tariffs from the US or a bigger economic dip could push the bank to cut later this year, but only if inflation stays under control. So if you found this helpful, hit the like and subscribe and let me know in the comments, do you believe the bank will cut rates later this year? And I'll be back with more real estate and economic updates. See you next time.